real estate investing has been the cornerstone of wealth creation for majority of wealthy people in the world. But that doesn't just mean that you go and buy any real estate asset and expect to make money out of it. Fact is that it's going to be one of the bulkiest purchases that you're ever going to make. And even a difference of 1 or 2% in return over a 10, 15 or 20-year period can literally mean that you either end up with hundreds of thousands of dollars more money or hundreds of thousands of dollars worth of less money depending on the return that your property produces. A good real estate asset will typically have capital appreciation potential, high yield, as well as tax benefits associated with it. A lot of people will just go and buy a real estate asset which may only have one of these three benefits, but if you can get all three in a real estate asset, then you're really maximizing your chances of being able to create wealth out of this asset. Now, when I look at buying real estate for myself, or even when high net worth clients approach us for real estate acquisition, we apply a research-based approach. And the reason for that is because we want to maximize the ROI, the return on investment that people get. And obviously for ourselves as well, we want to make sure that we're boosting and accelerating our wealth creation. So how do we do it? Well, we look at a number of indicators that tell us whether an asset is worth buying or not when it comes to real estate investing. The first indicator is we look at vacancy rates. And the vacancy rates simply mean what percentage of people are not renting properties in the area, as in how many properties that are available for rent are sitting vacant on the market. The higher the vacancy rate, the less attractive the real estate asset is. So a high vacancy rate for us would indicate that there is a possibility that the real estate investment is not as good as something with a low vacancy rate. The second thing that we look at is population growth. Obviously, population growth means that there are more people moving into the area. That naturally drives price growth. And so if population growth is increasing or it's higher than another area, then we would naturally pick an area where the population growth is higher, because that just means there is a higher probability of price growth. The third indicator that we would look at is infrastructure spending. Obviously, the more infrastructure spending is taking place by the local government, by the state government, or by the national government, medical facilities, hospitals, schools, shopping centers, all of those sorts of things would indicate that infrastructure is going to attract more population, and that's eventually going to drive price growth as well. The fourth indicator that we look at is days on market. If you find that the days on market for sales is coming down, that is a good thing. That means that the properties are coming on the market and they're selling very quickly. So the quicker sales indicate that there's a demand for the area. So we look at diminishing days on market for sales, which is an indication that this also is an attractive place to invest. The fifth thing that we look at is the stock. If the stock is declining fast, and we know that the population is increasing, then that's going to put supply pressure on the market. So that simply means we're looking at that variable and we're going, well, the stock is reducing, the demand is increasing. That's going to put upward pressure on the price. And that also makes the property or the area quite attractive from an investment point of view. The sixth thing that we look at is the type of population, the type of demographics. So we ideally want people that are not too young or not too old. We want people that are approaching their peak earning capacity. And so we would then look at data around, well, who are the people that are actually approaching their peak earning capacity? Because if they're approaching their peak earning capacity, they've got more and more disposable incomes. A lot of that disposable income is going to go back into their homes. So that's the sixth indicator that we look at. The seventh indicator that we look at is the percentage of investors to owner-occupiers, people who actually live in the house versus investing. And we ideally want to buy in an area where the concentration of people that live in the area is a lot higher than the people who are investing, because generally people who actually live in the houses will take care of the street, take care of their homes, take care of the area a lot more than people who are simply investing and looking to make money. So for our investors, we actually want to get them, or even if I'm investing personally, or our team is investing personally, we want to get them into an area where there is a higher concentration of owner-occupiers, meaning people who actually occupy the house that they're living in, compared to investors. The other thing that we look at is housing affordability. We ideally want to again buy in an area where the housing affordability is not very low. Ideally, we want that the actual house price, and when we look at the EMI or the mortgage payments, what we want is we want to make sure that there is a gap between people's incomes and the EMI payments. So the bigger the gap, the more we know that means it's affordable. If it's affordable, there is propensity for it to go up. If it's not affordable, then it's not going to go up much. And that's really the thing that we look at. The next factor that we look at is the actual property itself. We look at land to building ratio, because generally speaking, if it's in a good area, this doesn't apply in all areas, but if in a good area, the land will typically appreciate and the buildings will depreciate. So we want to make sure that the land to building ratio is good, that there is a lot of land and we're not just paying for the building. Then the next thing that we look at is, if you're buying a property, we look at who's the builder and the developer. Is it a quality builder or developer? Is it a builder or developer? If it's a new property, we want to make sure that the developer or the builder has significant backing, financial backing, and they're not going to go bankrupt through the construction process, because that's another way that people lose a lot of money. The reason I'm sharing this with you is because when people think about real estate investing, sometimes they watch YouTube videos and they watch influencers talking about real estate investing, but they don't really understand the finer nuances of ensuring that you're buying a high quality asset in the real estate market. People just have a very simplistic approach. They assume that if they just go and buy any property, that property is going to do well, not realizing that the investors who actually make money are the ones that apply and deploy a sophisticated research methodology and a selection and acquisition methodology, which is why they end up getting far greater than average returns, which ultimately results in boosting their financial wealth.